What are derivatives? In this video we will figure out what are their types, why do they exist and how do they work, how to work with them and how to earn money with them, and what they're all about. So fasten your seatbelts and we are starting our journey. First and foremost, the derivatives are securities that give you the right to buy or sell primary securities at the same time without buying the asset itself. By buying a derivative, you actually purchase the right to speculate on changes in the underlying securities prices. The derivatives allow you to trade on the prices of commodities, usually exchange-traded commodities such as grain, meat, oil, gold, on the prices of major securities. These are usually stock indices, stocks and bonds. On the credit market prices such as interest rates, on the currency market prices such as exchange rates, and on the cryptocurrency prices, of course cryptocurrency rates. The derivatives include free-floating options, futures contracts, forward contracts, and in some cases swaps. So let us now take a closer look at them. Options are financial contracts that give the investor the right, but not the obligation, to buy option call or sell option put securities at a predetermined price within a specified period of time. The investor can purchase an option call on a company's share if he or she believes that the price will rise in the future, or purchase an option put if he or she believes the price will decrease. Options are often used to hedge against unfavorable changes in asset prices. If the price moves in your favor, you can effectively use your right to buy or sell the option and profit from it. However, if the price moves against you, your only risk is the cost of the option itself, without losing money as if you had bought the actual security. This is an excellent risk hedging tool. Futures differ from options in that they are contracts to buy or sell a specific asset in the future at a predetermined price and date. Accordingly, you no longer have the right to refuse the purchase of the asset. Investors and traders enter into futures contracts to buy or sell goods, currencies, financial instruments, and other assets for the purpose of speculation or protection against price fluctuations. For example, you expect that due to certain events, the price of the company's share that you own may decrease in the short term. However, you don't want to get rid of your shares as you receive dividends from them. In such a situation, you can purchase futures contracts to sell same kinds of shares, and as their market price falls, you will profit from this decline. Essentially, the value of the shares in your portfolio has decreased, but you have earned from this decline, maintaining the balance at the previous level, or at least remaining at break-even. Forwards are agreements that share a similar concept with options and futures. In a forward transaction, two parties agree to buy or sell a specific asset, such as goods or currency, at a predetermined price and on a specified future date. However, like options, forwards do not impose an obligation to execute the transaction. Forwards are less standardized and are typically used for individual or specific transactions, such as hedging against price fluctuations or conducting international business. Let's say you own a company that operates globally and you decide to enter into a 5-year-long trade agreement for monthly deliveries of, let's say, electronics from Japan. In such a scenario, you can enter into a forward contract to buy yen or sell dollar at a specific price level, aiming to fix the exchange rate and thereby minimize potential risks arising from currency fluctuations. And let's not forget about swaps. Swaps are financial agreements between two parties that allow them to exchange payments or assets based on predefined conditions over a specified period of time. The main objectives of swaps are risk management, speculation, and as a result, generating additional financial income. Swaps involve various financial parameters such as interest rates, currency exchange rates, credits, or commodity prices. Based on these conditions, different types of swaps exist: interest rate swaps, currency swaps, credit swaps, and commodity swaps. Swaps are considered to be one of the most flexible instruments in the financial market, as their usage depends on specific needs and strategies of market participants. Knowledge is power, and now you know more about the derivatives and their area of application, and therefore you can use your new knowledge in practice. If you enjoyed the video, like and subscribe to my channel in order not to miss new interesting videos on financial topics. And see you soon!
Hasta la vista, baby.